Aloha folks, thank you so much for checking out this video. If you are new to my channel, my name is Mark, Mr. Dividend Investor. In this video, we are going to dive in and look at a company that has been rewarding investors for a century, guys. This company is one of those rare dividend kings. For the past 100 years, the company has been a true force in the market, consistently generating value and growth for its investors. This is a company that has stood the test of time. If you're interested, sit back, grab your favorite drink, enjoy the video. As always, please remember that all this information is not financial advice. This is just me sharing. Do me a favor as well. Hit that like button, hit that subscribe button, don't forget to hit the notification bell so you don't miss out on any of the videos that I put out. With that said, let's take a look at this company. So the company that I'm talking about is Church & Dwight. The ticker symbol is CHD. This is a consumer staples company that engages in the development, manufacture, and marketing of household, personal care, and specialty products. So pretty much, I think you probably have this in your house. A lot of us use Arm & Hammer and some of the products over here, as well as cleaning supplies. So definitely, I know if you were to go to your kitchen and all these and other places, you'll find these products. You probably use it as well. So let's switch over to an investment calculator. So if you were to have invested on this 10 years ago on 7/19/2013, you would have bought an original share of 160. Your original value would have been 10,000, your initial investments. 10 years, and you would have profited 204%, which will have your current value of 31,000, and then your shares would have gotten from 160 to 320, and then also at that point there was a split adjustment of 2 times. So definitely something to think about. Now let's take a look at Motley Fool. So based on the return versus the S&P 500, you can see here for the year it's at 4 versus the S&P at 15, and then the 5-year one is 78 versus 62, and then 5-year annualized of 12 and 10, and then since it's IPO, it's up 8,000%. Now we move over to tip ranks, and then based on tip ranks of performance, they rated as 2 actually. And then if you look at some of the information here, hedge funds have decreased their shares, and then insider transactions have sold their shares. Now if you look over here, the 5-year growth would have been 88%. Analysis forecast right here, you can see is the target is 99, and it's a moderate buy. They feel like it's a 1% upside with the high of 113, the average of 99, and then the low of 78. Now moving over to Simply Safe Dividend. Based on their dividend safety score, they rated as 99, which is very safe. The dividend yield is 1.12. And then let's take a look at the key metrics. You can see payout ratio is 35. It's considered low for consumer staples. And then you got your 4-hour payout ratio of 34, which is also low. I like to see this one, recession. They've increased their dividend. And check this out, guys, 122 years without a reduction. Yeah, that's just pretty amazing. Dividend growth, the last 20 years, 16%, which is very fast. The last 5 years is 7%, which is average, and the latest is pretty slow at 3%. Now, if you look at the chart here, you can see 26 years of consecutive increases. For the past 26 years, they have increased their dividend, and then for 122 years, they have been giving dividends without a reduction. That's pretty solid. Not only they've been doing it for 122 years, but for 26 years they've increased it. So definitely something to think about. Payment details: you get paid quarterly in the month of March, June, September, and December. Annual payout will be $1.09 per share. Ex-dividend date is May 12th, which has passed, and then you get your payout of June 1st. Timeline, it looks reasonably valued, and if you look at the dividend yield, it's under the 5-year average, and then forward PE ratio is a little bit higher than the 5-year average. PE ratio is about 30 versus the consumer is about 22, and the 52-week range is close to the high of 100. Looking at financials, you can see payout ratio is right there, 34% the last 12. Forward payout ratio is about the same. Earnings per share is at $3. Free cash flow is right there. And then you got your sales, earnings per share growth, outstanding sales in the millions, and then tail of billions. Return on investment capital, you can see 15%. And then you got your return on equity, which is 12%. Now let's switch over to Seeking Alpha, and then let's look at what they have. So the dividend grades, you can see right here. Dividend yield is a D, and then you got your dividend growth of A+, dividend safety of B, and then dividend consistency is A+. And then you got over here 5-year growth of 5%, dividend growth of 18, and then payout ratio is 35. And then over here you got all your dividend grades right there. Now if we go over to Nasdaq, based on their analysis, 20 analysis rated as a buy, and then here are the firms that have recommendations. Some of them are like Citigroup, Barclays, JP Morgan, you can see right here, Wells Fargo, just to name a few. Now we go over to CNN Business. Looking at what their forecast is, you can see a high of 108, the median of 99, and then the low of 78, with recommendations of 5 buy and 11 holds, and then you got 4 sells over here. Now we swing over to Zack's research. You can see based on their Zack rank is the 2, which is you can see right here, yeah? But they rate it as a buy, and then you got your values over here. Zack score and all that stuff, right? So you got your cash flow, PE ratio, price book is 6, and then you get your Zack rating of a 2. Now we swing over to Barchart. Based on their analysis, they rate it as a strong buy, 88% is a buy. Now looking over down to some of their current holdings, you can see 17 analysis, 5 holds, 1 moderate buy, 7 hold, and then you got your sells over here, yeah. And then your price performance for the 52-week range, that would have been up by 4. 3 months, it's up by 7, and then you got your 1 month, it's up by 2%. And then over here, right here, you want to take a look at the key turning points of the resistance points and the support level. So just to kind of keep an eye. And then now moving over to StockRover, based on their analysis, they rated as a hold. 17 analysis of them. 5 says hold, 1 buy, 1 strong sell, and then you got 3 strong sells. Now looking over and comparing it to the industry versus the S&P 500, I wanted to see the risk and return. As you can see right here, 3-year return 18 versus the S&P of 47. But the 5-year return is much better, 91% versus the S&P of 76. Now we get to compare that with Yahoo Finance. As you can see right here from the chart, the green one is the CHD, and then the blue one is actually the S&P 500, and then the green is the CHD. As you can see right here, the 5-year return, you can see that the S&P 500 is beat it right here, but then it's still pretty much mirroring it in a way, but CHD still has been performed better. Now the last thing you want to look at is alpha spread, sorry. And then one of the key points over here, you can see positive ROE. So you can see right here, our return on equity 23%, and then you got positive growth profit, positive free cash flow, and then you got your positive 3-year revenue growth. Now if we go a little bit more to the fundamental analysis, you can see revenue has been going up 2%. Operation and income, you can see, has decreased, And then you got your net income has also decreased. Operation cash flow has reduced by 14%. Free cash flow of 16% compared to previous quarter. And then you got your balance sheet of 8% versus 4% liabilities versus assets. And then look at here, you can see the gross margin, operating margin, net margin, ROE, ROA, ROIC, ROCE. So definitely check that out. My take on this, I think it is a solid company. It is a company that I think if you're looking for a consumer staples dividend company, yeah, you definitely want to check this out and do more research. You can't go wrong with this company. It has been rewarding dividend investors for 122 years, and in my opinion, it is a product that everybody uses, so I think it's going to continue for another 100 years. But definitely make sure you check, do your research, and do me a favor and check out the other videos as well. Thank you so much for watching. Hope you like this video. Stay cool, keep investing, and I'll catch you guys in the next video, right? Take care. Aloha.